what's the market telling us right now?
I mean, my general advice to a lot of investors that are starting out that have had no properties, I say get 3 or 4 resi properties behind you, learn the basics of investing, and then we start buying commercial.
A lot of doctors don't realize is you can lock yourself in for a long time on a lease. You can go as many terms as you want. You might have a 5 by 5 by 5 by 5, and you can have 20 years locked in.
Wealth for me is spending time with family, doing what I want, when I want, with whoever I want. It's just choice. Everyone has a different definition of wealth. My point is that we help people create that wealth.
There has to be a purpose to wealth. There's no point just building wealth if it's taking away from something. There needs to be a purpose to your investing.
And I know this is going to be a slightly controversial topic, residential or commercial. Hi everyone, welcome to another installment of the Investing for Doctors podcast. Today we have back with us again, Rich Harvey and Steve Palise. Welcome back, guys.
Thanks very much, B.
Thanks, B.
All right, so Rich is of course the CEO and founder of Propertybuyer, and Steve Palise is the owner of Palise Property. Today we're going to be talking about commercial property as an investment asset. First of all, what is the definition of a commercial property? And what are the ranges of properties that you would consider fall under this sort of asset class?
All right, so for me, commercial is any property where the whole purpose of the tenant is to make profit. So anyone who's in a property and the goal is effectively business to make profit, that's what a commercial property is. And it can overlap with residential as well. As doctors know, you can have a GP practice in a residential house. And then we've got the other ones, obviously, like industrial, retail, office space, and then specialized, which is like petrol stations, cinemas, car washes, and things like that. But for me, it's just anyone where the tenant is to make money. That's the purpose of it.
And Rich, is that?
It covers it all. Yeah, it covers it all. All the asset classes, mate.
Yeah.
Oh, sorry.
Tick right, mate. 100%. You took a commercial exam, all done, mate.
So in summary, it's anything that you're not renting to a tenant who lives in it.
Correct.
Yeah. So even
it's
like
a commercial enterprise.
Do you think Airbnb is a commercial enterprise, or does that fall
No,
under?
because Airbnb is you've got holiday makers. So that's for individual people, holiday makers to rent out. I mean, you can argue that there's crossover, but commercial is, as Steve said, it's you're leasing out a property for a commercial enterprise.
Okay, so you're
one of the grey areas, and it's not a commercial property, but you'll need a commercial loan for it, is if you're buying a whole block of apartments. So they're all individual tenants, but the banks will look at it as a commercial investment.
Okay.
So certain lenders have different rules. Some lenders is 3 apartments, most it's 4.
Yeah. So if I bought like say a block of 4 units, that's a commercial property.
Not a commercial property. It's considered a commercial loan.
Commercial loan.
Not considered a commercial.
Okay. Okay. So we got to break that up a bit.
Correct.
So what is the difference between a residential loan and a commercial loan then?
Well, typically on a commercial loan, you typically LVR's around, you got to put in 30%. So your loan to value ratio will be around 70%. Whereas on resi loans, obviously doctors can go 90, 95%. Standard resi buyers are around 80% before you pay lender's mortgage insurance. So there's considered different risk factors.
Yeah. And from a loan serviceability criteria and the rates you're paying, is there much difference in that?
Yeah, there is. You want to talk about the rates?
Yeah, so rates are pretty good at the moment. They're actually about 0.5% different. Typically, they used to be 1 to 1.5% different. But one of the things Rich didn't say is there's different types of commercial loans as well. So you can still do the full documentation, full servicing type loan. There's also a loan called Lease Stock loans. So it's a loan based on the property itself and how long and strong the lease is. So basically, the property needs to wash its own face. So they'll look at what portion of the rent will cover the mortgage, and that's where they'll work out the loan to value ratio. But they're really strong because effectively you don't have a servicing limit. So as long as you've got the capital deposit, you can infinitely buy commercial properties, whereas residential you can't because you run out of servicing.
Yeah, that's amazing. I mean, we've touched on that in the previous podcast. So for those that want to listen more about that, you can refer to our previous episode with you, Steve. Now, doctors. They often when doctors get into commercial properties, it tends to be their clinic. What are the aspects? How does one sort of appraise that, value that, and look into buying such a commercial property? Because often they'll be in a block of existing specialist rooms, or it will be a GP practice where you're building a whole practice. There's obviously a whole range of different kind of properties they can buy in depending on how they are running their practice. But what are the general sort of key considerations when you're doing that?
Well, I'll answer it first if you like. I think depending on what practice you're in, whether you're a dentist, we've helped dentists buy practices. We've helped a gastroenterologist buy Maryland's, and that was a house. That was a residential house that he converted into a consulting room. So it really just depends on where your client base is coming from, and buying an appropriate property that's going to have enough parking, it's going to have ease of access, obviously maybe wheelchair access, and also the right amenities for all your equipment. I mean, obviously dentists, you're going to have all of the the plumbing and the different requirements and the suction and everything. And obviously, if you've got a surgery, you might need things. I'm not a medical person, but there's stuff hanging from the roof. You might need an extra 400 millimeters of space there, so you need higher ceilings. So you've just got to buy a property that's fit for purpose. In the summary, because there's two aspects to it. There's obviously the benefit of your business, because that's a doctor, especially when they're working for, it's a business. You're trying to make profit, so you want all the aspects that means the profitable business. Then the other aspect is it a good investment as well? And you don't want to dilute those waters as well, because you don't want to buy an absolutely dud investment because your business does really well, because then you're losing on one front. That might be when the option is to rent and lease a property out as opposed to buy. But if you can get both of them working, then you win on both fronts. Investment and business both booming. That's how you make true wealth.
I mean, in general, most medical practices are in sort of population growth areas where there's lots of amenities. You tend not to have a practice that's sitting in the middle of nowhere with
yes and no, because it depends what style of doctor you are as well. Like GP clinics,
you got a super GP
universal,
clinic,
and then certain like specialized ones that typically, like you mentioned before, the office suites where there's lots of specialists and things like that, which they're already kind of pre-prepared, and unless you're the first one going in, you kind of know what's doing. But you can also do your due diligence. You actually talk to the other doctors and find out about the block, the parking, if there's any issues with the building, how they like it and things like that. So, but again, it depends on what type of buying. We bought one recently in Penrith, a little shopping centre for a GP. There's no GP there, but he wanted to go in that location. So we're kind of killing two birds with one stone. We're buying a good investment class one with multiple tenants, and he gets to put his his GP practice in, which is actually going to increase the value of the property.
Of the whole property.
That's right, because now he's medical as well. And then there's a flow-on effect of pharmacies and things like that.
I was just going to make that point. Often where you're choosing to locate your business premises, look at who else is around in the neighbourhood. Is there a PRP X-rays place next door? Is there another pharmacy? Because that also brings traffic naturally, and you feed off each other. So I think it's important not to be too isolated in where you're looking to locate.
So back to that shopping centre strategy, it almost like the GP practice is going to be the anchoring tenant for that entire block, because that block is not really perhaps doing as much, but having them there is going to bring in additional foot traffic for every other business. And so they can then lease the rest of the place out to either pathology or a pharmacy or even a radiology practice.
But it doesn't even have to go that far. Like at the moment, I think there's a hairdresser, a cafe, and it's still got those other fundamentals. So it's got all different foot traffic, and then they get the local kind of like road traffic and people going into the GP clinic. So, but again, that's more of a business kind of decision for your practice with the value add of
the other things.
Having other ones. The hard one for me is when like the specialists, like, I don't know, the ENT surgeons and things like that, just have a random office in a high density room. And as we spoke about in the last podcast, we don't like high density apartments because there's no land component. So you're almost buying an investment that doesn't have good fundamentals, but it's also not necessarily a bad investment decision because you need that location because there's the setup for the medical practice. So there's more to it than that. And then there's also tax savings and things like that. So that's the hard gray area for me to come up with a kind of
So we often see the specialist suite sort of kind of purchases, and they often put in a self-managed super fund, and then there's a rent going through to that to some.
But you can still have those offices in like a ground floor single story building as well, which we've seen in a lot of those when you have like the pathology, and then like you have like a couple of specialists, and they've even got like chiropractors and physios and that. They've got the land component, so that can be a good one. It's the same business effectively renting the room, but a completely different asset.
So that's a very interesting topic, because what we're seeing now is that there's a concentration of medical specialty sort of services in these sort of office blocks, and I think Dexus likes building some of these things. Like they built the private in North Shore, and there's obviously selling the individual office suites out. Any pitfalls in getting into those kind of
It's the same fundamentals as residential. You still got to do your due diligence. So you still got to look at build quality, do inspections, do body corporate reports, look at comparable sales, look at oversupply, look at what infrastructure is coming in the future. If they're building another 20-story tower next door, talk to town planners. You've still got all those fundamentals, which, no offense to doctors, most of them don't do it. They see that there's 4 or 5 other doctors there. They buy it and they get on with it.
Yeah, I'd just say the oversupply thing would be the number one thing I'd be looking for.
Yeah.
You know, what is in train in development applications with council for more medical space? Will that absolutely saturate the market, or is there a real constriction of supply in that area?
One of the questions from you, and we probably don't experience this as much as you, is the oversupply or undersupply of doctors, because you might have an oversupply office suites, but if they're on that floor where all the doctors want to be because it's near the hospital or whatever it might be, that can still make sense. And what we're saying is you might not get the same capital growth, but it doesn't necessarily mean it's a bad investment for a doctor, because they need somewhere. So whether they rent or buy is another question.
And I guess they got to look at what they're going to pay in rent anyway versus what they're going to be paying to service the loan and all that sort of thing. And if it's cheaper to actually just buy the place, it might be a worthwhile to go.
It also depends, and this is the counter argument I sometimes make, is it depends what and where you're buying.
I love counter arguments.
So if you're, let's say you weren't the tenant and it was just a normal tenant, and that office suite was a 4% net yield. And you could go buy a solid 6% net yield retail shop or industrial property. So you're effectively getting 50% more rent on it. You could theoretically go buy that investment and have 50% more rent to rent somewhere 50% larger or in a slightly better location. So that there's always a counter argument to what's actually beneficial. And then
it's like the rent vesting opportunity.
That's right. It's a rent vesting opportunity. And then what a lot of doctors don't realize is you can lock yourself in for a long time on a lease. Like you can go as many terms as you want. You might have a 5 by 5 by 5 by 5, and you can have 20 years locked in, because a lot of the counter arguments to doctors, they say, I don't want to be kicked out, this is my location. Negotiate a lease. If I'm an owner of a property and a doctor comes to me and says, can I sign 5-year leases by 4 terms? Brilliant, happy days, let's sign on the dotted line. And then you're secure for 20 years. The lease terms aren't for the benefit of the actual owner,
it's for the tenant. Because they have to explain to some people what does 5 plus 5 plus 5 plus 5 means.
So when you're a tenant, you'll typically sign a lease term of whatever length it can be. It can be 12 months, 2 years. Normally they're 3 to 5 years. And then you'll have an additional term. So it'll be like a 3-year plus a 3-year plus a 3-year. At the end of the 3 years, you can actually move out, and there's no restriction. They normally do a market review and they'll check the rent. But as long as you're willing to pay market rent, you then get it. No, they can't pull it from out under your feet. Where it becomes dangerous at the end of the full lease terms, that theoretically you could be kicked out. But that's why you negotiate lots of lease terms, and it locks you in for a long period, which a lot of people don't do. They feel there's some reason in their head they think if I sign lots of lease terms, there's too
but you're only committed for the first.
You're only committed for the first.
Yeah, that's right.
So that's a little trick, is try to get as long as you can, especially if your business and livelihood depends on it.
Just gives you that option. What do you do, Steve, in terms of locking in the market rent? Because as the owner of the property, or you want to make sure you're getting good quality rent. You don't want to be undercutting yourself, right? So how do you do that in your lease agreements?
So you just basically, it depends on, like 5 years ago, having 3 to 5% fixed rental increases on a lease were quite attractive because CPI was much lower than that. Now that inflation's much higher, people want inflation. I always tell people it doesn't actually make that big of a difference. Because it's only for that lease term. So if you're on a 3 or 4 year lease, yes, you might lose, a few $1,000s a year, but then it's coming back to market rate. The other point of note is if you've got too many fixed increases and it goes above market, I can guarantee your tenant will start complaining. They'll come back to you and say, we're paying way too much. And most of the time you'll probably reduce the rent for them because you don't want to go to our business.
You don't want to lose them,
That's right. So, but it's just looking at comparables. So when you get to the market review, you got to find other properties that are similar, and then you present it to the client. The tenant can actually argue it. And then you'll normally get like a short form valuation for rental valuation, and then they'll come to it. And then they can disagree or agree with it from there. But normally with certain types, it's pretty easy. Like an office suite, you've got lots of comparables. There's 200 comparables for square meter rates. Something like a GP clinic on like a ground, like a freestanding building. That's a lot harder because the local cafe has a different square meter rate as a medical. And then the medical center 2 kilometers away has completely different foot traffic, road traffic, different demand, a different vibe of the area, different age building. That's a bit of a harder one. But typical rule of thumb is if you follow inflation, that's where it's going to be, because it's got to be affordable to businesses and investors effectively.
Let's move beyond sort of the owner-occupied medical practices. So in your sort of journey helping investors get into commercial real estate, what are the sort of more attractive sort of types of assets? We've seen how working from home has really hit the office space rental and also the value. I've heard of lots of office spaces, they renovate the entire place and they decided not to go into the lease, and someone else moves in, gets the benefit of all the renovation and pays even less than what the original guys were going to do. So what's the market telling us right now?
I think for our clients that buy commercial, industrial has been fantastic. I mean, that's really not so much flavor of the month, it's flavor of the last couple of years. Really, that's been a wonderful asset class. And the benchmark is minimum 6% net as a yield that our investors are getting. So, for $1.5 million, getting a great asset, and then you've got 4+4 or 5+5 year leases. It's a great thing to hold in your trust or in your super fund, and just keeps washing its face and paying positive cash flow. They've been great assets, and they're low maintenance. There's low outgoings typically for the owner, for the tenant as well, and they've been really, really good. We've done some really good ones. Actually, one of our resi clients, he was really nervous. A quick story. He was really nervous about buying his first commercial property. He had about 20 properties, and it was like I bought him blocks of units and all sorts of other things for him. But his first commercial, he was so. I mean, I'm sure you've been through this. And he was like, not wavering on signing on the dotted line, but he just wanted extra due diligence done. So we found him a great opportunity up on the Central Coast, and it was I think it was about a $7 million purchase, and the lease had just been renewed by an international tenant on a 7+7 year lease. Right, really safe, extra period of time. He's still nervous, right? No, he paid $4 million. That's right, he paid $4 million for it. Anyway, he ended up buying it, and then luck just landed in his lap. 3 months later, another shed in that same complex sold for 20% more. Yeah. So he got uplift on equity, plus he got a fantastic yield. So to the point is that sometimes people just hesitate buying, but end up with a fantastic result.
The funny thing is I find, even with my personal investing when I buy commercial properties, is the better the deal, the more nervous I get, because I think I'm like, something's wrong with what am I missing? What am I missing that other people think? But I agree with Rich. Like industrials, the easiest to understand, especially at the moment, especially with like working from home, e-commerce boom, like vacancy rates have really come down. They used to be 6-7% in capital cities. Now we're talking 1 to 2% in most capital cities. It's also easier for the investor to get their head around, because if you've got 5 other warehouses in the complex, you can look at sold square meter rates, rental square meter rates. The adjoining complexes around the area, the tenants don't really care which one they're in. So you can all of a sudden get 20 comparables to making a smart decision. Something like a retail is a bit harder, because you've just got like the one
retail. There's a uniqueness to it that's harder to value.
There's a big misconception I want to talk about with retail is people say retail spending's down, which is correct, but our investors aren't buying Westfield shopping centres. Yes. So the retail movement, but because of COVID, suburban retail strips are actually performing quite well, because people are now going to their local cafe and hairdresser. They're not going to the city one. So some areas, like I own quite a few cafes, business have actually gone up since COVID because they've actually got more tenants in there. So there's a good option there. The other point I wanted to mention is you mentioned office space COVID. I wasn't buying office space prior to COVID anyway, even though the yields were attractive and it seemed quite low vacancy. But similar to our last podcast, I don't want to spend hundreds of thousands of dollars on Sky Space. Yes. Because they can always oversupply the market. If the market was ever to grow, it's going to stop, because then builders will come in and they'll build another 20-story skyscraper and to capitalize on that. So it's always going to have that drop off. So I never bought it prior to that anyway. I was always just sticking to fundamentals. Similar to residential, if I was buying office, and I have bought some in like Northern Beaches and Balgowlah, you buy the little blocks with 4 or 5 offices that are disservicing the local kind of area.
Going back to the industrial, you mentioned warehouses. Is there other forms of industrial sort of properties on sort of give us an example of the kind of tenants that go into these?
Well, it's mainly, with industrial, sometimes it's just, it might be even light manufacturing. It might be, someone who's like got a metal business and whatever, and they've got all the manufacturing on the floor and then their office upstairs on a mezzanine level. Could be a storage business, could be, landscapers, all sorts of those kind of, as generally is been a really good quality of asset.
So that's light industry.
Yeah, very light. So it's nothing heavy. No heavy kind of manufacturing. It's all just sort of, stock coming in, stock coming out, or manufacturing somewhere on the premises.
The type of industrial is typically based on the location. So you'll normally have like a service-based industry. So that's things like mechanics, panel beaters, spray painters, little kitchen fabricators, because they're servicing a small area. unless you've got a large budget, then you're buying like the big manufacturing ones, but most people aren't kind of buying those ones. Then there's the distribution type businesses. So they're the ones where you want smaller office space because they don't have workers like engineers and kind of draftsmen and things like that. But they're located in different regions because they need to be near highways or ports or airports. Whereas the service-based ones can be completely surrounded by residential because the mechanic is servicing the surrounding residential one. So the two types I normally identify are service-based and distribution, and where they're located is kind of gives you a gauge of what type of tenant you're going to get.
So back to that, these properties tend to also be quite high value in many instances, like, a couple $1 million.
I disagree somewhat. That's a bit of a misconception.
Yeah. Well, at least a 1-2 million sort of area ballpark.
We bought a $300,000 warehouse in Perth a couple of weeks ago. The negative with the small ones is you're not getting a big tenant and a long lease. They're going to be average Joe's electrical services, and he's going to sign 12-month leases.
You're not talking about a storage facility, right?
No, just a small warehouse, an old warehouse, and that's because all the client could afford. The thing is, they're only going to sign a 12-month lease. They're also more volatile because small businesses go one or two ways. They grow and outgrow the space, or they close up shop. So you're actually going to cycle through a new tenant every kind of 3-4 years, kind of as a minimum. But sometimes some of the areas, the vacancy rates are quite small. So you might only lose them for 2 or 3 months, which will erode the yield a little bit. But it is a misconception. The argument that I think Rich is going to make is the quality will typically increase as the price goes up.
We tend to find $1 million is really the minimum threshold.
Yep.
1 million upwards is tend to get that's exactly my point about the better quality. Like, you can buy stuff cheaper, but again, you might be compromised on the quality of tenant and the length of the lease that's going to be there for that property.
Same arguments as I keep saying with residential. You can buy $200,000 houses still in really risky areas, but it doesn't necessarily mean it's a good investment.
Yeah, I think maybe the view that you have to have a lot of money to get into commercial is because on social media you see the chemist warehouses moving into like one of these massive buildings, or the Bunnings moving to these like $30-40 million properties. So but of course the most of the smaller commercial real estate is not going to be anywhere near that price.
You can buy retail in Sydney, suburban retail for sub $1 million. Again, they've got their own risk, which we spoke about in the last podcast. But it just depends on kind of what you're getting. What changes as your price point goes up is the variety of things you start to look at. So once you start going more past that $1 million, you start looking at freestanding, multi-tenancy, more value add options, blue chip tenants. So like the big ones you were mentioning, like we bought a Bunnings Trade Centre in Perth for 4.4 mil. Like Bunnings, you got a Bunnings for that price. So you start looking at blue chip, and then obviously you go into the next ether, you start looking at the really big stuff.
Yeah. Do you find that some of your investors would come together to buy a much bigger place, or is that not as common as you hope it would be?
We don't syndicate. I mean, we have, some of them might have syndicated before they come to us. Like there might be 2 or 3 parties, or it might be a fund wants to go and buy a particular kind of asset.
Yes.
And that's fine. We do that, but we don't actually match people as such. We don't have a financial service license to do that. But I think, but to get the bigger quality of assets, you definitely need a better budget.
There's 2 words people get caught up on a little bit. It's like there's joint ventures. So that's just 2 investors coming together to buy something together, which is fine. You don't need financial service license. And then there's syndicates where you need a proper financial service license. Typically, they don't make sense unless you're buying 15-20 mil worth of investment because of the extra costs and legals. You also need to be what's called a sophisticated investor.
Yep.
So you need to be earning more than $250,000, have $1 million net worth.
I'll put in $500,000.
Yeah, put in $500,000, things like that.
Automatically makes you sophisticated.
But coincidentally, we've actually put a few tenants together. When we find a really good property, we've had clients that have been open to the bigger ones. So we bought an $8.5 million shopping centre in Perth, had 22 tenants, and it was a 7.4% net yield. So 2 guys that never met before, we introduced them by Zoom, and they've signed. The hard part is you need exit clauses. So you sign a contract saying in 5 years' time, if this happens, we sell. If we don't agree, we can sign another 5-year term. There's more complications to it. The only time that works is if you think you can buy a better quality asset at that price, but we both agree that you can buy a really good quality asset at $1 million.
Yeah.
So why add another layer of risk? Yeah. I'd much rather buy instead of buying an $8.5 million shopping centre, 4 $1 million ones and diversify the location, the type of asset, who the tenants are, the guarantees on the leases, and diversify that way.
And do you find the yields are roughly similar?
It depends on the asset class and the location.
Say when the maximum, it sort of plateaus up at a certain number.
I'm finding we're getting slightly better buying at a higher price point because there's less competitors. So you can sometimes get a bit of a better yield. But the caveat to that is who the tenant is. If you go buy a really blue chip tenant, you pay a premium for that. and you get a lower yield. So it's getting that balance
I
right.
think to your point, that sort of $5 to $15 million range is a really good sweet spot to work in because it's above the mum and dad investors, but it's below all the institutional investors. So that's a really good range to be buying in. Not to say you can't buy for between 1 and 5 million at all. There's definitely good opportunities there, but there's an extra level of opportunity in that range.
What's the ballpark yield in there, would you say?
Oh, 6 to 7.5%. Yeah.
That's the rental returns.
Yes.
What about the capital growth? It's hard.
It depends what you buy.
It's hard.
I mean, it depends on the location.
Yeah.
As I said on the last podcast, generally like capital growth is in line with the residential market, assuming you have a land component. So i.e. not an office space, because it's very unlikely you'll have $1 million house next to a $800,000 warehouse, and that $1 million house goes to $2 million and that stays at $800,000. Because if a tenant can pay for the $2 million house, why would the business not be able to pay? Where the myth comes from is they actually happen in different cycles sometimes.
Yes.
So they will actually be out of cycle, and that's where it comes from. People say, oh, commercial doesn't grow. Look, the office space hasn't grown at all. And you're like, okay, I didn't buy the office space. I bought that. I'm not saying don't buy residential because Mount Isa hasn't grown the same as Brisbane.
Yeah. No, that's interesting. So from your experience, roughly the same as residential. So let's just put a ballpark figure of 5%.
5 to 7%.
Yeah.
One of the funny things I actually say to people when they'll say, oh, commercial doesn't grow, it's too expensive. And I'm just like, well, that's an oxymoron, because how did it get more expensive if it didn't grow more? So they have to be comparable.
And I know this is going to be a slightly controversial topic. Residential or commercial, which one is, if you were just going for pure numbers?
Okay, well, Sydney or Melbourne, which child is your favourite? I mean, we can have a really good topic. I mean, it's a really good question to ask. It's a great question to ask. I think the answer is both. I think my general advice to a lot of investors that are starting out that have had no properties, I say get 3 or 4 resi properties behind you, learn the basics of investing, and then we start buying commercial. Because I mean, we could jump straight into commercial straight away, but the problem is we don't want to expose them. Not that I'm saying there's extra risk with the commercial, but there is the risk of vacancy. I don't want to we don't know if another COVID situation comes where had you bought, heaven forbid, a retail property, for example, and then the government mandates you are not allowed to kick the tenant out. You've got this loan, no money coming in. What do you do? That's a nightmare situation. So for a lot of investors that are starting on their journey, get a couple of resi properties, then let's start buying some commercial properties. But I think absolutely. I mean, I think a lot more mature investors, they kind of build up a big portfolio and then they rebalance and then end up selling a lot of resis because what I call the hassle factor. If you've got 50 properties that are resi properties versus 15 that are commercial, I know what I'd rather have.
I'm personally selling my resi portfolio and transferring into commercial because I'm all about cash flow, and I don't care, this is going to sound arrogant, I don't care about net wealth anymore because I'm wealthy enough. I just want to keep beefing up my passive income from 300 to 400 to 500 because that means I actually feel wealthier because there's disposable money for it. But flowing off from Rich's comments, I agree with everything he said. The other aspect to answer your question is the purpose of why you're buying and then assessing the advantages and disadvantages. So the disadvantage obviously is slightly higher risk. The other big disadvantage is you get lower LVRs with commercial. So you lose out I actually don't care about property as an asset class. I like that I get leverage because I get to magnify my returns. So if you're starting out and you've got access for a doctor 95% loan, I would much rather go buy 3 properties on 90% loans versus 1 commercial, because if I'm right and we get the same capital growth, you make 3 times as much with the resi portfolio, which then means you can buy commercial 3 times the size. But again, personal circumstances. If a client comes to me and they want to retire in 3 years, buying them in a negatively geared residential, even if they've got a bigger borrowing capacity, doesn't work. So it's just aligning your goals with what you've got to work with and then making a decision from there.
It's answering the question without really. But yeah, no, I appreciate it. So most of the customers that you see coming to you getting commercial properties, they'll have an established residential portfolio before
typically.
That's just
do you see the oddball that just I just want commercial, I don't want
resi? I get it all the time because I got the book in stores on commercial, so people read it and be like, why would I buy residential? I get same capital growth 3 times the cash flow, but there's always a circumstance of why they're doing that. And they're normally a business owner that their servicing isn't the issue. They've got the capital, so they want to get into the cash flow to step away from the business, or they want to get their partner go on like a paternity leave or maternity leave. So there's always a caveat to it. But if you're just a young aspiring investor, the deposit is the bottleneck for most people at the start. Then it shifts to servicing, which is then what brings people to commercial because they run out of servicing residential. They go, well, I can't keep buying. Let's shift to commercial.
So back to I think we're at the very start of this session, we spoke about the lease stock. And is that something that can help with overcoming the serviceability issues when you have too many residential? Because residential, after you get past a certain point, you're always going to run into that serviceability problem. Whereas with commercial, you generally find that it's not so much an issue.
But then the capital becomes the issue because you know with the lease stock loan, you don't get an 80% lend. Like typical most lease stocks are 50 to 65%, depending on what yield. So the LVR is based on the net yield that you get. So if you get a 7% net yield, you can probably get a 65% LVR. If you get a 4% net yield, you probably have to go 50% loan to value. So buying $1 million property, let's say you got a 50% deposit, plus stamp duty, you're talking like 650 grand effectively to get into the deal sometimes when you pay buyer's agent for like stamp duty, legals and all that type of stuff. That's a big chunk of cash. You're not going to have one of those every single year kind of thing. So that's the bottleneck to that. But theoretically, it's infinite borrowing. But that's where resi comes in. A lot of people have like I did. I had
equity unlocked.
I had a lot of properties that like 5 of the properties that I'm selling had doubled in value. So selling those, I theoretically have a 50% deposit on each of them for the equivalent value for commercial, but then I get 3 times the cash flow. So and I've transferred it that way, knowing that I'm losing out, like we spoke on last of already paid stamp duty once, I'm going to pay it again. Selling agent's going to take a couple %, then I'm going to pay some tax. Like it does erode that way, but my goal is no longer building net wealth. It's transferring into cash flow.
But it makes sense for you to do that, Steve, because you're at a different level to a lot of other investors. It makes sense to recycle that equity into a better overall cash flow return. So it's a really good strategy.
And sometimes you got to go back a little bit to move forward, I guess.
One of the things I point out though, when people kind of question me on it is I'm actually losing net wealth by this strategy. So because I've got a lower LVR, in 10 years time, I'm actually going to be less wealthy on paper because I don't have the same size portfolio. So assuming now I could have had an 80% portfolio, 80% LVR on residential, my portfolio is around 50% now. If the portfolio were to double, I'm making like 30% more capital by having the resi portfolio. But I'm not going to have the same lifestyle now, which is I mentioned before, like I travel quite a lot of the year.
But also if you look back on that, if you're having difficulty borrowing more money to build on that investment strategy, you have access to a bit more on the other way. It could be worthwhile, wouldn't it?
Wealth, there has to be a purpose to wealth. And I know it sounds a bit airy-fairy. There's no point just building wealth for the sake of building wealth if it's taking away from something. Like if you're like, oh, even though I can afford this, but then I can't go on a 3-month holiday every year, kind of what's the point? Like there needs to be a purpose to your investing.
I think there's a great phrase I heard once. It's called the economics of enough. The economics of enough is, okay, well, if you want 300 grand as a passive income, what wealth do you need to get to achieve that? And anything beyond that is just bonus, right? You don't want to be the wealthiest person in the graveyard, right? You want to spend, wealth for me is spending time with family, doing what I want, when I want, with whoever I want, like it's just choice at the end of the day, wealth. And everyone has a different definition of wealth. So I think, to Steve's point, my point is that we help people create that wealth, and you've got to get that right balance between capital growth in building your overall nest egg for one day when you want to rebalance your portfolio or retire completely, versus having that passive income where you can choose to work or not to work. I know a lot of doctors, are probably pretty wealthy, but they still really enjoy doing what they do. It's a sense of contribution, right? It's a sense of helping the community, and it's wonderful. Like we need more doctors in the community to be able to train other people. So I think there's that balance factor of, okay, you get enough wealth and then you can choose to work maybe 3 days a week instead of 5 or 6 days a week,
Yeah, the funny part to that is that what we find is that when doctors actually feel financially independent, they actually work more. Because they choose to work the work they want to do.
I actually started enjoying work more. Like working long hours doesn't feel like working long hours anymore because it's an active choice. It's not a grind like it used to be when I first started my business. You're working 12-hour days to like 2 a.m. every night. Like that was slogging away. Now that I don't have to, it's actually enjoyable because you close the laptop when you're done. But one of the points I always get whenever I do like a strategy call with someone, they always make up a passive income goal. Like, I want 200,000 of passive income. You're like, why do you want 200,000 passive income? So I can travel the world. I started my business in Europe and I worked for there for 2 years and I spent about 130 grand. So that's living it up. 200 grand a year is quite a lot of money. 4 grand a week's a lot to spend. So they could have theoretically got to their goal 5 or 10 years sooner and had the same lifestyle. So they're kind of sacrificing their life for a make-believe number.
Yeah. I think it comes back to what you mentioned. Have a plan, have a goal, what you want to know yourself. You know, I'm very big about this concept of understanding yourself, where you want to be, who you want to be, and where you want to be. And I think once you know that, you can make better financial decisions.
Absolutely.
Yeah. And have fun along the way.
Yeah, exactly.
Like it's got to be fun. Otherwise, what's the point?
Exactly. Yeah, exactly. So before we finish, any last words?
Probably for me, for the biggest one with commercial is because of the risk we spoke about is do your due diligence. That's the big one. So all the moving parts of residential, you have that plus all the other stuff: lease review, contract review, tenant interviews, road and traffic analysis,
all the business stuff,
vacancy studies, occupancy studies, business competition analysis. If you don't want to use that, contact one of us.
Yeah, absolutely. Absolutely. Rich?
Yeah, I think there's no time like today. You know, I think, as I said before, setting a goal, achieving it, and you know, there's always going to be tomorrow. There's always going to be I'm going to do it, but there's no time like today. So set a goal, take some action steps, and step out and achieve it.
Beautiful. Thank you, gentlemen.
Thanks, B.
Thank you, B.
Look forward to having a chat with you again in the future.
Thank you.
Thanks, guys.
This podcast is for educational and entertainment purposes only. The information and opinions shared are not intended as personal financial advice. The content presented should not be relied upon for making financial, investment, or other decisions. Listeners are strongly encouraged to seek the advice of qualified financial or legal professionals before making any financial decisions. While we aim to provide valuable and accurate information, we make no guarantees regarding the completeness or accuracy of the content. Any reliance on the information provided is done at your own risk.